When the market crashes, what happens inside your head? Fear, doubt, panic. Every headline screams disaster. Every dip feels like a free fall, and your portfolio, it looks like it's crumbling. Suddenly, the pressure to sell everything is overwhelming. But here's the problem. Reacting out of fear can cost you more than the crash itself. In this video, I'll show you Buffett's timeless rules for navigating the emotional chaos of investing. I'll explain what to do before, during, and after a crash. I'll also show you how to avoid the common traps that derail most investors and how to position yourself for success, no matter how bad the market gets. What sets Warren Buffett apart isn't just his financial acumen. It's how he simplifies investing into a framework anyone can follow. At the heart of his philosophy is a profound respect for understanding what you're investing in. Buffett's mantra is simple: don't chase trends or gamble on unknowns. Instead, dig deep, research companies you truly understand, and avoid anything outside his circle of competence. As he famously said, risk comes from not knowing what you're doing. This approach is what makes him so steady during market turmoil. For Buffett, a stock market crash isn't a crisis. It's an opportunity. His preparation is rooted in fundamentals, knowing the value of the companies he invests in, maintaining patience, and sticking to businesses with strong competitive advantages or moats. While others are swept up in panic or speculation, Buffett relies on his confidence in the data and the strength of his strategy. Another cornerstone of Buffett's mindset is focusing on what he calls inevitables. Businesses with such strong brands or market positions that they're likely to succeed over decades. Companies like Coca-Cola or Apple dominate his portfolio because he believes in their long-term resilience, regardless of market fluctuations. This is why he's never tempted to jump into speculative tech trends or fads. He plays the long game. Understanding this mindset sets the stage for what's next, which is rules to follow before a crash. Preparation is the key to surviving any storm, and the stock market is no exception. Success doesn't come from predicting the future. It's about being ready for anything.
People should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become, whereas the longer the maturity of a bond, the more risky it becomes.
Buffett has a rule: only invest in what you truly understand. He calls this staying within your circle of competence. Take his investment in Coca-Cola as an example. In 1988, Buffett purchased more than $1 billion worth of Coca-Cola shares, roughly 6.2% of the company at the time. His reasoning? He understood its business model, global brand, and loyal customer base. Decades later, Coca-Cola remains one of Buffett's largest holdings, having returned over $20 billion in value. Buffett avoided trendy industries he didn't understand, like technology in the 1990s, even as the dot-com bubble inflated. Focusing on businesses he confidently evaluated, he dodged the fallout when the bubble burst. Another pillar of Buffett's preparation is focusing on quality, prioritizing companies with strong fundamentals and durable competitive advantages, or moats. Apple has long been a prime example in his portfolio. When Buffett began investing in the tech giant in 2016, it wasn't just about buying a company. It was about believing in its ecosystem of loyal users and seamless product integration. Recently, Berkshire Hathaway's 13F filing revealed a surprising move. It sold more than 389 million Apple shares, cutting its position by nearly half. This raised concerns about Buffett's confidence in Apple, but the stock remains Berkshire's largest holding, accounting for 28.8% of its portfolio, more than 3 times larger than its next biggest position. And the recent sell-off was mostly to secure the winning amid future tax increases and market valuations, which is on the high side. The move reflects Buffett's ability to adjust holdings tactically while staying committed to the quality and resilience Apple represents in his strategy. Liquidity is another cornerstone of Buffett's strategy. During the 2008 financial crisis, when the market was in freefall, Buffett had billions in cash reserves ready to deploy. While others were panicking, Buffett struck deals with Goldman Sachs, injecting $5 million capital in exchange for preferred stock with lucrative terms. These investments not only stabilized the companies, but also earned Berkshire Hathaway billions in profits. Buffett also advocates for thoughtful diversification. He's famously quoted as saying, "Diversification is protection against ignorance." This doesn't mean spreading money across dozens of stocks, but rather concentrating on a few well-researched investments. Consider Berkshire Hathaway's portfolio. Its top 5 holdings, Apple, Bank of America, Coca-Cola, Chevron, and American Express, account for over 75% of its value. Each of these companies has been carefully selected for its ability to deliver long-term returns. Focusing on fewer high-quality investments means avoiding the pitfalls of over-diversification, where mediocre performers dilute overall returns. Preparation also means looking to the past for lessons. Buffett has spent decades studying historical market crashes, from the Great Depression to the dot-com bust. He often refers to the 1973 to 74 bear market, when Berkshire Hathaway aggressively bought undervalued stocks like the Washington Post. By the early 1980s, this investment had multiplied several times over, showcasing the rewards of buying during downturns. While history doesn't repeat itself exactly, it offers invaluable patterns for understanding investor behavior and market resilience. Finally, avoid speculation at all costs. Buffett doesn't chase stocks based on hype or try to time the market. For example, during the Bitcoin craze of the late 2010s, Buffett famously stated that he wouldn't invest in cryptocurrency because it lacked intrinsic value. Instead, he focuses on businesses with clear earnings potential and strong fundamentals. His philosophy is simple. If he wouldn't hold a stock for at least 10 years, he wouldn't buy it. This long-term perspective shields his portfolio from the volatility that often devastates speculative investments. So, what to do during a crash? The market plunges in a matter of days. Headlines scream panic. Investors dump their stocks, turning paper losses into real ones. This is the chaos that Warren Buffett has spent a lifetime thriving in. Crashes are where you make money. Let's go back to October 19th, 1987, Black Monday. The Dow Jones Industrial Average plunged 22% in a single day, the largest one-day percentage drop in history. Buffett didn't sell a single stock, proving his mantra. An investor should act as though they have a lifetime decision card with just 20 punches on it. His ability to hold steady, trusting the value of his investments, has paid off time and time again. But sticking to the plan doesn't mean doing nothing. When crashes happen, Buffett is ready to pounce on bargains. Think of the 2008 financial crisis. While Lehman Brothers was collapsing and banks were scrambling for cash, Buffett was cutting deals. He invested $5 billion in Goldman Sachs, receiving preferred shares with a 10% dividend, plus warrants to buy stock at a discount. That one deal netted Berkshire Hathaway a $3.7 billion profit by 2011. He also injected $3 billion into General Electric under similar terms, securing Berkshire another lucrative deal. Cash flow is another critical element. Buffett ensures that the businesses he invests in can generate income even during tough times. Take his famous investment in American Express during the 1963 salad oil scandal. The company was on the verge of collapse after a fraud scandal, and its stock tanked. Buffett invested aggressively, convinced of the company's resilience. Today, that investment is worth billions, proving the importance of backing businesses that can weather storms.
The biggest mistakes we've made, by far, are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you got to grab them when they come.
Market crashes are inevitable. Since 1928, the S&P 500 has experienced 26 bear markets, defined as drops of 20% or more. That's roughly one crash every 4 years. But here's the catch. Over its history, the S&P 500 has grown from single-digit levels in its early days to almost 6,000 today, which is a 25.18% increase, an extraordinary testament to the ability of long-term market growth. Crashes are temporary, but the market's growth over time is permanent. This is the big picture that Buffett never loses sight of, and it's one that every investor should keep in mind. If you'd invested $10,000 in the S&P 500 in March 2009, the bottom of the financial crisis, you'd have over $64,000 today in 2024, even accounting for the COVID-19 crash. Those who panic sold during the downturn locked in losses, while those who held steady captured the recovery. The big picture is, crashes aren't roadblocks, they're part of the journey. By understanding market history, maintaining liquidity, and keeping your long-term goals in focus, you can turn market turbulence into an advantage. Want to know what Warren Buffett's advice is if the S&P returns 3% over the next 10 years? Click the video on the screen to find out.